Hello, and welcome to AI Market News by LM. Let's get right into it. Iran war. Trump rejects peace. Are we looking at $150 oil next? The geopolitical landscape is literally shifting beneath our feet today, and it's sending massive shockwaves across the entire globe.
So, setting the stage for today's explainer, we really need to ask, with peace talks totally stalling out and oil futures jumping 4%, are we heading toward a catastrophic energy shock? What we're witnessing right now is this massive, high-stakes tug-of-war. On one side, escalating geopolitical risks in the Middle East, and on the other, incredibly resilient global markets that just refuse to blink. According to various news commentary and our prepared resources, President Trump has firmly rejected the latest peace offer from Iran, basically calling it completely unacceptable. The proposed deal? Iran offered to transfer some of its highly enriched uranium stockpile to a third country, but, and here's the kicker, they absolutely refused to dismantle their nuclear facilities. So, that's what led to this current diplomatic stalemate.
And we're absolutely feeling the real-world impact of this. We are 10 weeks into this conflict now, and the prolonged war is putting heavy pressure on energy markets. Both Brent and WTI futures have spiked. But surprisingly, the physical market is kind of learning to live with this new reality. They're figuring out how to adapt, just in case these trade disruptions become a prolonged everyday hurdle.
Which brings us to the core tension of our explainer today. It's a classic showdown: geopolitical risk versus market momentum. We're tracking a very real fear of oil rocketing up to $150 a barrel. That would drastically drive up upstream costs and seriously threaten global growth. Yet, sitting right across from that intense fear, we have the surprising, undeniable resilience of the equity markets. And we can see this resilience crystal clear when looking at the overall market. The S&P 500 is pushing record highs right around 7,398, and the NASDAQ is just massively outperforming. The Dow Jones, impressively stable. Over in the currency space, the euro to US dollar pair is sitting totally flat at 1.1777, while the US dollar to yen is feeling immense pressure at 156.98. The bottom line here is that US equities are aggressively pushing higher, completely brushing off the looming threat of an oil shock.
So why exactly are equities ignoring these massive geopolitical risks? Well, it all comes down to the AI equity boom. We should really pay close attention to this massive AI hardware trade because it's essentially acting as a giant buffer for Asian and US markets against those heavy macroeconomic headwinds. I mean, look at the Kospi index in South Korea. It is up a staggering 75% this year. The unbelievable momentum behind companies like Samsung, SK Hynix, and the whole expanding TSMC ecosystem is providing a massive counterweight to global fears.
And this tech boom is totally reshaping the broader financial landscape too. Big tech is getting super creative to finance this expansion. Based on the prepared resources, Alphabet is making a totally unprecedented move by planning its first ever yen-denominated bond issuance. They are tapping directly into the Japanese market to raise capital for their colossal $190 billion capex plans, all to build out that crucial AI infrastructure. Naturally, all this aggressive capital movement shifts our focus straight to currencies. As seen in the provided information, the US dollar to yen pair is hovering near a highly critical level at 156.98. The yen is under some serious pressure right now. In response to this volatility, US Treasury Secretary Scott Bessent is actually heading to Japan to discuss currency stability with his counterparts right ahead of the highly anticipated Trump-Xi summit.
So, how is this intense environment affecting investor psychology? When we look at the components of the Fear and Greed Index, we see a fascinating split. On one side, we have fear, driven by market volatility and safe haven demand as investors naturally seek cover from the Iran war. But pushing back hard against that is greed, heavily fueled by incredible stock price breadth and the sheer, unstoppable strength of the tech rally.
Transitioning over to the bond market, U.S. inflation expectations are clearly on the rise. The U.S. 10-year yield has been stubbornly hovering around 4.38%. Thanks to sticky inflation and the very real prospect of prolonged high oil prices, traders are actively pricing out the possibility of any significant interest rate cuts this year. The market is getting the message that higher for longer might just be the reality.
Adding even more complexity to this picture is a massive structural shift happening at the Federal Reserve this week. With Jerome Powell stepping down, Kevin Warsh is stepping up to take the reins. Given the resilient consumer data and soaring energy prices, the new chair might actually have his hand forced right out of the gate. In fact, rate hikes could potentially be back on the table to combat an inflation that simply refuses to cool down.
But wait,
There is a powerful technical engine driving this stock rally as well, and we have to talk about it. It's called a gamma squeeze. Right now, retail and institutional investors are aggressively buying call options, essentially placing massive bets that the market will keep going up. This forces options market makers to buy the underlying stock to hedge their own risk, which artificially rockets the markets even higher in the short term. It's like pouring gasoline on the fire.
As we look ahead to the investing.com economic calendar, we have a critical, jam-packed schedule on U.S. time that could absolutely make or break this rally. Early in the week, we have major U.S. Treasury auctions to watch. Midweek brings the always crucial U.S. CPI inflation data. Then Thursday features the incredibly high-stakes Trump-Xi summit in Beijing. And to top it all off, Friday brings the notoriously volatile triple witching options expiry. It is going to be a wild ride. Which brings us to a final, provocative question to wrap up our explainer today. Can this massive AI hardware rally really survive prolonged geopolitical tension and shifting monetary policy? We are basically witnessing the ultimate tug-of-war between a historic technological revolution and harsh macroeconomic reality. It's a fascinating dynamic, and we will be watching closely to see how this week unfolds. This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.